Welcome to The Explainer. Today we're diving into a really crucial and, let's be honest, kind of uncomfortable truth about your money. It's this idea that just saving cash in a bank account might actually be making you poorer day by day through the silent theft of inflation.
So, let's kick things off with a fundamental question. Is your money really safe in the bank? Now, I don't mean safe from a bank robber. I mean safe from losing its actual value, its power to buy you the things you need and want. You probably think, yeah, of course it is. But the reality? Well, it's a lot more complicated than that. And here's the core of the problem, right here on the screen. On one hand, you have your savings account, maybe earning a teeny tiny interest rate, something like 0.01%. Basically nothing. On the other hand, you have inflation, the rate at which prices are going up, maybe hovering around 3.6%. That's not just a gap, it's a canyon. Your money is basically standing still, while the cost of everything else is on an escalator going up fast.
So let's be super clear about what this means. This isn't just a matter of your money failing to keep up. No, it's actively losing its ability to buy stuff. Every single day your cash just sits in that safe bank account, its real-world value is shrinking. You've got the same number of dollars, sure, but you absolutely do not have the same amount of wealth.
Okay, so here's our game plan for today. First, we're going to talk about the problem you can actually feel, your shrinking dollar. Then we'll pull back the curtain on the money printing machine that's causing it. After that, we'll zoom out even more to look at the huge systemic risks at play. We'll touch on these massive long-term death cycles. And then, most importantly, we'll land on how you can shift from just being a saver to becoming an investor.
All right, let's start right where it hits home for all of us. In your wallet, at the gas pump, at the grocery store. This isn't some abstract economic theory we're talking about. This is the reality of your day-to-day life and the money you've worked so hard to put away.
You know this feeling, right? You see the prices for gas and food just keep creeping up. You hear scary stories about the stock market going up and down, and it makes you nervous. So what's the natural reaction? You stick your money in the bank because, hey, it feels safe. But when CDs are paying you less than 0.5%, that feeling of safety is really just an illusion. You're basically swapping the sharp, sudden risk of the market for the slow, quiet, guaranteed loss from inflation.
This whole thing really boils down to one key idea: purchasing power. See, a dollar isn't just a dollar. Its real value is all about what it can buy. Think about it. Maybe your grandpa could buy a soda for a nickel. Today, that same soda costs you more than $1. The dollar itself has lost a ton of its purchasing power over time. And inflation, that's the engine that's driving the whole process.
And this quote just nails it. You have the same amount of currency, but you don't have the same amount of wealth. You can look at your bank statement and see the same $10,000 you had last year, but that money just can't buy what it used to. And that, my friends, is a real loss of wealth.
So, if your dollar is getting diluted, you've got to ask, who's pouring in all the water? Let's take a look at the actual mechanics of how more money gets created and pushed into the system.
The main tool they use has this fancy name, quantitative easing, or just QE. It sounds super complex, but think of it like this. The central bank essentially creates new digital money out of thin air and then uses it to buy things like government bonds from the big commercial banks. The whole point, especially after a crisis like 2008, is to flood the system with cash. The hope is that this pushes down interest rates and encourages everyone, people and businesses, to borrow and spend and, get the economy going again.
And this kicks off a chain reaction. It's actually pretty logical when you lay it out. First, the central bank prints money. That expands the total amount of money floating around. But here's the catch. The amount of actual stuff to buy, the cars, the houses, the food, it hasn't increased at the same speed. So you end up with more money chasing the same amount of goods. Basic economics tells you what happens next. Prices go up. And the end result? Your individual dollar gets diluted and it buys less.
Now, this is where things get really weird, almost totally upside down. In this kind of system, if you're a saver, someone who's been responsible, putting cash aside, you actually get punished. Your savings lose value every year. But if you're a debtor, someone who's borrowed a lot of money, like for a mortgage, you actually win. You get to pay back that old loan with future dollars that are worth way, way less than the ones you originally borrowed. I mean, listen to this wild example to see how extreme it can get. Let's say you took out a $300,000 mortgage years ago. Now imagine hyperinflation hits and a single banana suddenly costs $300,000. You could literally sell one banana and pay off your entire house. It's a crazy thought, but it perfectly shows how your debt, which is fixed in old, more valuable dollars, gets wiped out by new, cheap ones.
Okay, but the danger isn't just your dollar slowly getting weaker. There are bigger, more catastrophic risks that can threaten the entire financial system all at once. We're not talking about one part of the economy having a bad day, we're talking about the very foundation starting to crack.
So to really get this, let's compare two different kinds of risk. First, you have non-systemic risk. That's like one company failing. Say BP has a huge oil spill and its stock tanks. That's bad if you own that one stock, but the problem is pretty much contained. Then you have systemic risk. That's what we all saw in 2008. The entire mortgage market imploded, and it almost took down the entire global banking system with it. In that situation, it didn't matter how diversified you were, your whole 401k was at risk because the whole system was in deep, deep trouble.
So what's feeding this bigger systemic risk? Well, it's these giant, slow-moving forces, things like governments piling up enormous amounts of debt, huge unfunded promises for programs like Medicare and Social Security, the long-term effects of keeping interest rates near zero for years and years, which just encourages more and more borrowing, and the fact that our global banking system is so interconnected that one big failure can set off a domino effect around the world.
And that leads to this really powerful way of thinking about it. I can't control whether Titanic goes down, but I can control whether I choose to get on without a lifeboat. You and we can't stop a government from printing money. We can't prevent the next big financial crisis, but we can control how we prepare for it. We can choose to build our own financial lifeboat.
Now, let's zoom out one more level. As scary as all this sounds, it's actually not some new, crazy phenomenon. What we're seeing is part of a massive, long-term economic cycle that has played out over and over again throughout history. It's called a deleveraging.
So what is a deleveraging? Well, it happens after decades of debt growing way faster than income. You can think of it as the giant economy-wide hangover that comes after a long, wild party of easy credit and borrowing. At some point, the debt just gets too big to handle and the whole system has to correct itself. It's a painful process, and we saw it during the Great Depression and again in 2008.
And this process can turn into a vicious, self-feeding downward spiral. It starts when people cut their spending so they can pay down their debts. But remember, one person's spending is another person's income. So incomes start to fall. That makes it even harder to pay off debts, so credit just vanishes. People start selling off assets, stocks, houses to get cash, which floods the market and makes prices crash. And here's the really tricky part. Unlike a normal recession, the central bank can't just lower interest rates to fix it, because they're already at or near zero.
When they're trapped in this cycle, policymakers basically have 4 ways they can try to get out. 3 of them are deflationary and pretty painful. Austerity, which means cutting spending, letting people and businesses default on their debts, and redistributing wealth through higher taxes. And then there's the 4th option, printing new money, which is inflationary. Now, the ideal solution is what the source material calls a beautiful deleveraging. That's where policymakers skillfully balance all 4 of those levers to try and ease the pain without causing total chaos. But let's face it, austerity, defaults, and higher taxes are incredibly unpopular. The path of least resistance almost every single time is to just turn on the money printer.
Okay, wow, that was a lot of heavy, big picture stuff. So let's bring it all the way back down to what this really means for you and the choices that you can make. How do you actually build that lifeboat we were talking about and protect yourself in this kind of environment?
The first thing to understand is that the fundamental rules of money have changed. The old rule book that your parents and grandparents played by, a penny saved is a penny earned, that was true back then. Money in the bank held its value. Well, that norm is gone. The new reality we live in is that currency itself is a depreciating asset, kind of like a car that starts losing value the second you drive it off the lot.
And this quote reframes the entire goal of saving. It's not about piling up currency anymore. It's about using your currency to buy assets. The point is to save up enough currency so that you can afford to trade it for things that will actually hold or even increase their value over time while the currency itself is losing value.
One of the key strategies for doing this is called hedging. Now, don't let the fancy word throw you off. At its core, hedging is really just about balance. It's about owning different kinds of things that don't all move in the same direction at the same time. The whole goal is to protect your overall wealth from a catastrophic loss in any one single area. Think of it like a simple teeter-totter. On one side, you've got the US dollar. On the other side, you have a tangible asset, like a gold bar. When the value of the dollar goes down because of inflation, the price of gold, which is measured in those cheaper dollars, often goes up. So one side goes down, the other goes up, and it helps keep your overall net worth much more stable.
So when we talk about assets, what are we even talking about?
Well, we're talking about things that have real, intrinsic value or the ability to generate income. This could be owning a piece of a business through stocks, owning productive real estate, or hard assets like gold and silver that have held their value for thousands of years. It can even include certain financial instruments that are specifically designed to move in the opposite direction of the broader market.
And all of this leaves us with one essential final question. In a world where our currency is constantly being diluted, what is true wealth? The answer, it seems, is changing. It's becoming less about the number of dollars you have in your account and more about the quality and the diversity of the real assets that you own. Because in the end, true wealth is resilience.